But our next guest says today's record Nasdaq rally is much more grounded in reality. Joining me now is Nick Colas, co-founder of DataTrek Research. Nick, it's good to have you on. You and I, we were both there. We saw it up close in '99. And I do find it interesting, I think, to start, that this debate always pops up and seems like it almost over-anticipates this moment when things might be getting out of hand. But what do you think are the most relevant benchmarks to compare?
Yeah, you're right. It is an interesting conversation, and we have it every couple of years, and we're having it now. The way I look at it is, there's more than just price action that dictates a bubble. So, for example, the IPO market gets super hot during a bubble. So in the 1990s, the average IPO was up 25 to 40% in the first day of trading, and it was a very heavy IPO calendar. We don't have that. We also don't have those kind of hallmark deals like AOL Time Warner that happened in the early 2000s, where you had a big tech company taking over a traditional company. We don't have any of that dynamic now. And the Nasdaq's only up 41% over the last 12 months. We're not in bubble territory until we hit a double. That's what happened through February 2000. So we don't have any of the real ingredients that make it similar, make today's environment similar to 1999, 2000.
I mean, yeah, the Nasdaq basically tripled in less than 2 years, I think, going into the top. So the velocity of gain's not there. But, I mean, you'll find some folks who will look at a few things, such as, you can overlay what NVIDIA's done on Cisco from that period of time in terms of the magnitude of gains. Yeah, the valuation's not as high as Cisco was, but also the concentration of the market and how big semiconductors or tech more broadly are within the index. And it just feels as if there's some of the atmospheric conditions that would suggest maybe taking some care.
Yeah, no, it's a fair point. And just because you're not in a bubble doesn't mean you don't still go straight up. So all the usual caveats about investing apply. But look, I mean, over the long term, the market's driven by really a handful of stocks. 1 to 2% of stocks are responsible for all the gains in global and U.S. equities from 1990 to 2020. So abnormally concentrated leadership is not unusual, and it tends to be in tech names. So we're kind of checking all those boxes right now.
Yeah, and again, you started off by saying, that you have some pretty strict definitional conditions for what a bubble is or what you should call a bubble. And I think it's worth reminding folks that really, if you say something's at a bubble or a bubble is peaking, you mean it could be cut in half in value or go down by 75% to get back to the trend, which is what happened to the Nasdaq.
Yes, exactly. I mean, again, our benchmark is a double is a bubble, and it happens in oil markets. It happens with the S&P over a 3-year period. It happens with the Nasdaq over a 1-year period. That's the thing to look for, that kind of tremendous price velocity, which is not justified by fundamentals and could never be, because the market's not 100% dumb in any given year. So seeing a double means we're in a bubble.
I guess setting aside the grading, what we're looking at here relative to 99, does it feel as if people are perhaps just over-extrapolating the good news at the moment, or do you feel like mostly, this is grounded in some real economic fundamentals?
Yeah, this to me feels like a classic mid-cycle market where you're not going into a recession, that's late cycle, and you're not in a recession, that's early cycle. Everything else is kind of in the middle. And the market always climbs this proverbial wall of worry during a mid-cycle market. They worry about rates, they worry about earnings, they worry about concentration. These are all the same dynamics that we have right now. But again, based on what we've been talking about, not a bubble by any means, just kind of a normal grinding higher mid-cycle market.
Yeah, I've seen you, write a bit about that, this sort of mid-cycle environment. And while it seems as if you were to look in retrospect at those periods on a chart, you'd say, well, that was easy. You just sort of sat there and did not much of anything, and the market kind of did its work for you and appreciating relatively slowly or relatively orderly. It's hard, though, to be honest. It's hard to feel as if the market isn't missing something when it's mostly just repricing the same news every day almost.
Yeah, that's very fair. It is just because things are quiet with a VIX below 15 and actual volatility quite low doesn't mean it's easy. In some ways, it's harder because you're always looking around the corner for that next shoe to drop, and it doesn't until the end of a cycle. And I don't think we're there yet.